there's no fever like gold fever. So we start getting all those things you outlined that's in gold's favor. What else could happen? It could be a psychology. It could be equities are going down. My pension doesn't look good. I haven't saved enough. Gold's starting to move. Fear of missing out. We get even more momentum. I wouldn't rule that out. I'm not trying to talk out of both sides of my mouth. Technically, it looks like it's due for a correction. But is that 2 days, 2 months, or 2 years? I'm not sure. Because I think gold is much stronger than it would be under better conditions economically. And so it's kind of hinting to us that, in my opinion, the worst is yet to come or the best is yet to come, depending if you're, betting a lot on the gold market or not. But even in a very high-priced or high-value gold, let's call it value.
The U.S. dollar remains resilient following the Federal Reserve's projection of only 225 basis point rate cuts by year-end. This strength prompts traders to take profits and scale back their bullish positions on commodities heading into the weekend. As a result, gold dips 0.19% as the dollar gains ground. DavidMorgan, a widely recognized analyst in the precious metals industry who consults for hedge funds, high-net-worth investors, mining companies, depositories, and bullion dealers, remains bullish on gold. He emphasizes that despite occasional sharp corrections, such as brief 1 or 2 day drops, gold could continue marching higher. He explains that markets can remain overbought for long periods, and as the saying goes, there's no fever like gold fever. If macroeconomic conditions favor gold, its momentum could strengthen even further. Historically, 2 assets stand out as ultimate safe havens: the US dollar, as the world's reserve currency, and gold, as the purest form of money. In times of economic instability, especially in countries like Turkey, Argentina, or Venezuela, people flock to US dollars because they trust its value. However, a subset of investors seeking the highest level of security turns to gold. Central banks have been aggressively increasing their gold holdings, with purchases in January reaching levels 7 times higher than the pre-2022 average. This surge reflects growing concerns over the safety of US dollar reserves and treasury holdings, signaling a broader shift in how institutions and investors protect their wealth. DavidMorgan warns that when we reach the end game, the financial landscape will change drastically. At that stage, the focus will shift from speculation to pure capital preservation. Investors will no longer ask, "How much can I make?" Instead, their primary concern will be, "How much can I avoid losing?" Let's jump into the video for more details. If you like what you see, please thumbs up and subscribe to our channel to stay updated with our latest content.
At the end of as the liquidity squeeze starts in earnest, both the gold and dollar go up at the same time. And that's why I think that the gold, I've said it well over a year ago, Peter, I said the run to gold has started. And people are, "Oh, what is he talking about?" Right? He's a gold bug. What does he know? And of course, we've seen the market go from, I don't know when I said that, probably 2,600 to over 3,000 now. And what I meant was the big money, the smart money's moving into gold. Central bank buying was huge over the last couple of years, and that continues, as you said. And going back, and I'm not trying to discount what I'm saying, but I'm adding on to what you said. We could just see this thing continue, and why is that? Well, if we get a stock market pullback of enough magnitude that we see a shift in the allocation from equities into commodities, which I expect is taking place or beginning to take place, we could just keep marching forward, get those maybe 1 day or 2 day kind of downdrafts that look somewhat scary because a $50 move in gold isn't that big a percentage anymore. And then people get shaken out or say, "Oh, I'm going to wait." And the market just keeps going up. The best way to maintain a position in these type of markets, if you're in, follow it up with not a real tight stop, but a stop, and let the market decide for you when to get out. And I do that with my trading position. I'm in for the long haul for my core position. And if you're new and you're worried, you're an equity guy, and most of your net worth is in equities, and now it's starting to roll over, definitely buy some gold. You don't have to bet the farm. And what do? What I just said, you get in at 3,000, you put a stop at, you look at the chart, or you could just use a percentage. You could use 6-7%. And then if it moves against you, you lost 6%. But if it keeps going up, just keep moving your stop up. And these markets can be overbought for a long time. And last statement, I'll give it back to you, Peter. And this is an old adage. You're probably old enough to have heard it, but there's no fever like gold fever. So we start getting all those things you outlined that's in gold's favor. What else could happen? It could be a psychology. It could be equities are going down. My pension doesn't look good. I haven't saved enough. Gold's starting to move. Fear of missing out. We get even more momentum. I wouldn't rule that out. I'm not trying to talk out of both sides of my mouth. Technically, it looks like it's due for a correction. But is that 2 days, 2 months, or 2 years? I'm not sure. But when we get to what I call the end game, or people refer to as the end game, this is where, again, we go from that upside down pyramid where people are seeking security. They're no longer interested in how much of a gain can I make in the stock market. They're interested in, I don't want to lose anything. I don't want to lose any more than I've already lost. And when you get that change, that's when people seek the safety. And there's two of the safest things known to the financial markets and the man on the street. That is, that piece of paper has value. I'm not in an investment that could go up and down. I'm not in stocks. I'm not in bonds. I'm not in private equity. I'm not in anything. I'm in the bank, and I'm in the bank in dollars, being number one because it's the reserve currency. So if you're in a third world country or a less advanced economy like Turkey or Argentina or Venezuela or Southeast Asia, you want greenbacks, and that's what they'll buy. That's what they trust. A subset of that, the ultimate money, is gold. So you'll see money flow into the US dollar and gold at the same time for one reason and one reason only, and that's for safety.
Wall Street has been on a volatile ride for weeks, with stock prices fluctuating amid uncertainty over the economic impact of Trump's trade war. The recent decline, which pushed the broad U.S. stock market more than 10% below its all-time high in just a few weeks, was likely overdue. Stock prices had surged faster than corporate profits, making valuations appear unsustainable. Meanwhile, growing criticism of Elon Musk is weighing heavily on Tesla, with the electric vehicle maker emerging as one of the worst performers in the S&P 500, down over 40% this year. Gold, on the other hand, has been a clear beneficiary of the stock market turmoil, and according to DavidMorgan, that trend is unlikely to change as long as uncertainty persists. He remains bullish on gold's long-term prospects, anticipating significantly higher prices in the coming year. However, he warns that the path upward won't be without sharp corrections. Morgan believes that the broader market's struggles stem from misallocated capital and political interference, which are distorting economic fundamentals and preventing a fair and balanced financial system. Now, let's redirect our attention to a video.
Technically looks bad. A lot of the smart money always refer to Warren Buffett. I mean, Buffett's got a lot of cash on the side. A lot of your billionaire class are not out of the market, but lightened up considerably, noticeably. They've had to file with the SEC so that everyone becomes aware of it. And because of those facts, and the market's long in the tooth, and we've been in a distribution pattern. And I showed for my private work the true price of the stock market, and that's done versus gold, not versus the dollar. And that's one of the books back here called The Invisible Crash. So if you measure the stock market, the S&P 500 specifically in terms of gold, it peaked in the year 2000. And what we have is a huge, massive head and shoulders formation. And right now, the right shoulder, which is where we are in time and space right now, it's a right shoulder that's peaking out and rolling over. And I really believe that's the most accurate way to look at the future, technically. And it shows we're rolling over in the stock market. In terms of gold, we might be going higher in terms of a number, but gold's outperforming as it did last year. And these gold miners, these top tier gold miners, are really got huge margins. They're the value stocks right now. And I just think, as I said earlier, the run to gold has begun, and that the run will continue. As I said on another interview, the run to gold is a very light walk, and then it's a brisk walk, and then it's a light jog, then it's a full jog, then it's a slight run, then it's a run, and then it's a sprint. And that analogy is how it goes. And we're just getting into, I think, the brisk walk right now. Once we start into the jog, that's when I think the public starts to wake up and says, you know what? I've got X amount in my 401k. I don't know what the equivalent in Britain is, but my retirement fund has this, and I'm all equities. And equities have gone down this amount. Gold's up 30% last year. Damn it, I'm going to get some of my retirement in the gold market. And it just takes that new momentum to start pushing it higher. So I'm still bullish. I really think gold's going to be much higher a year from now. But again, I don't like to get people too excited because it's like any market, it does move up and down. But the reality is we can't live in this debt-based economy much longer. We just can't solve the puzzle. It's a math problem, not a political problem. And because of those facts, I think gold is much stronger than it would be under better conditions economically. And so it's kind of hinting to us that, in my opinion, the worst is yet to come or the best is yet to come, depending if you're, betting a lot on the gold market or not. But even in a very high priced or high value gold, let's call it value. So gold's buying a lot more, men's suits or more oil or more wheat or whatever. So its value is higher. Isn't necessarily good for the economy, because what it would indicate, and it has always in the past, is that the macro picture is we're starting to slide in our productive capacity, which means a lower standard of living, not a higher standard of living. Of course, we want the highest standard of living for everybody. I mean, we want enough abundance that everybody on the planet thrives. And that, of course, is not potentially, I think it's there, but staying on track in this train of thought, we're not going to see it because of the misallocations of capital due to the political pressures that so many of the economics are dictated by people that don't know much at all about how to run an economy in a free market, fair, equitable, and balanced situation. There's no perfect thing in life, but the more they meddle, the more they mess it up.
The U.S. debt has only surpassed GDP twice, during World War II and now, highlighting the severity of the current economic landscape. Trade wars reinforce the technical outlook, but deeper issues are at play. Stocks continue to struggle, while interest rates remain steady as capital shifts from equities to treasury bills and bonds. Meanwhile, firms promoting gold as a store of value often highlight the selling price but rarely mention the buyback price. As paper assets decline across the board, gold has finally surged to $3,000, reflecting its growing role as a safe haven asset in uncertain times. Join the conversation. Share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.